the current account balance for the January to August period last year, it showed a little sign of improvement. We saw where the deficit narrowed about 60 million when you compare last year's 8 months to 2009 8 months. We see where, you know, it somewhat contracted at about like 60 million, and this stemmed mainly from all the sub-accounts excluding the goods account.
Okay. So
we saw increases in interest in tourist expenditure, also in remittances, and we saw some lower external interest payments. However, when we look at the goods account, we see where that deteriorated for the period as a result of rising imports and lower exports. Now, we know that we have, because of the decline or the downturn in the bauxite industry, that has impacted our exportation levels currently. So we see where we continue to see a decline in exports as a result of lower alumina and also lower ethanol.
Right.
Now, on the import side now, what we see, or what is causing the increase, is actually higher international oil prices, because we're seeing that the cost that we're actually paying for mineral fuels has increased relative to the previous comparable period. So again, the fact that the oil price is actually trending higher, this is impacting our goods account, which will eventually impact the current account balance.
Well, I think we're having, I don't think our viewers are seeing the current account slide. So, but you know, just to say that we're working on it and they will see it, we're working to solve that. But just to say that as far as the current account is concerned, and as Nikki suggests, I think the main risk there is the oil price, right? Rising commodity prices that could throw it, you know, out of whack. The good thing is that we have, you look at the NIR, it's building, right? The gross reserve is hovering about like 3 billion, 2.9 billion.
Yes,
about the NIR is about 2.1 billion dollars. So, you know, that's a good thing as far as mitigating the risk. But, you know, surely the clear and present danger is rising oil prices, right? That could throw the current account out of whack.
The improved story as it relates to, in terms of growth, or, you know, improved story as it relates to growth in the States, and certainly our main trading partners in Europe, in particular UK. How does that feed in terms of our remittance levels and our tourism levels that we're expecting?
Right. Well, unfortunately, you know, we're not seeing the graph here.
Yes.
But you know what it will show is that there's actually been an improvement situation. So that actually Nikeisha developed more on the point.
Yes. So what we've been seeing, you know, we have been seeing a resurgence in remittance growth since November 2009, and it continues to improve. It's still not at the previous levels or prior to 2008 before the crisis, but we see a continued improvement on the remittance side, and it's somewhat reflective of the job market in the US. You know, yes. As you were saying, you know, we're seeing some form of improvement now. Well, slower. It's slow. It's not as fast as where we want it to be, but we're still seeing some improvements. So that is actually, you know, translating, you know, to the remittances, and also on the tourist arrival side, we see a pickup there as well. We still not have. Well, we have emerged to positive territory when you look at the year-over-year growth in tourist arrivals to Jamaica, and this would also includes cruise ship arrivals. So, you know, on those two fronts, you know, as a result of the improvement that we're seeing, or the mild improvement that we're seeing in the U.S. economy, you know, we see those areas picking up for us, you know, which will positively impact the current account.
Right.
Just for the benefit of our viewers, we're working on having the slides being able to move, but we'll just move forward nonetheless.
Right. So I think it's real GDP growth that we are looking at next.
Okay.